वेलकम टू वीलन। वीलन में आपका स्वागत है। सब्जेक्ट सिक्योरिटी एनालिसिस एंड पोर्टफोलियो मैनेजमेंट। सेशन नंबर 11। टॉपिक कवर्ड इन दिस सेशन: रिक्वायर्ड ऑफ ए पोर्टफोलियो मैनेजर, पोर्टफोलियो परफॉर्मेंस मेजर, अपोजिट पोर्टफोलियो परफॉर्मेंस मेजर, and now what is required of a portfolio manager. The ability to drive above average returns for a given risk class. Superior risk adjusted returns can be derived from either superior timing or superior security selection. The ability to diversify the portfolio completely to eliminate unsystematic risk relative to the portfolio's benchmark. Composite portfolio performance measures. Portfolio evaluation before 1960. Rate of return within risk classes. Peer group comparison, like no explicit adjustment for risk, difficult to form comparable peer groups. The portfolio performance measure market risk, individual security risk, introduced characteristic line. And now portfolio performance measures, the recognized two components of risk. Number one, risk from general market fluctuations. Number two, risk from unique fluctuation in the securities in the portfolio. जनरल मार्केट फ्लैक्चुएशंस क्या है कि जो जनरल मार्केट के अंदर जो स्विंग हो रहा है, जो उतार चढ़ाव होते हैं, उसको रिकॉग्नाइज करना है। एंड यूनिक फ्लैक्चुएशन जो हमेशा होते रहते हैं विदाउट एनी चेंज, तो वो आपके यूनिक फ्लैक्चुएशंस होते हैं, उनको दे आर ऑल्सो कंसिडर एट द टाइम टू measure the performance of portfolio. His measures of risk adjusted performance focus on portfolio's undiversifiable risk. अनडाइवर्सिफिएबल रिस्क जो होती है उसकी तरफ जो है फोकस करेंगे फॉर द मेजर ऑफ रिस्क एडजस्टमेंट एंड मार्केट और सिस्टमेटिक रिस्क की तरफ करेंगे. देन पोर्टफोलियो परफॉर्मेंस मेजर्स इज डिटरमाइंड बाय यूजिंग द फार्मूला T इक्वल टू R बार माइनस RF बार डिवाइडेड बाई बीटा I. The numerator is the risk premium. The denominator is a measure of risk. The expression is the risk premium return per unit of risk. Risk averse investors prefer to maximize this value, and this assumes a completely diversified portfolio, leaving systematic risk as the relevant risk. Comparing a portfolio's T value to a similar measure for the market portfolio indicates whether the portfolio would plot above the SML. Calculate the T value for the aggregate market as follows: Tm equal to Rm bar minus Rf bar divided by beta m. Comparison to see whether actual return of portfolio G was above or below expectation can be made using ERG equal to RFR plus beta I Rm minus RFR. And now Sharpe portfolio performance. Risk premium earned per unit of risk is determined by the Sharpe scholars of the financial management, is given as SI equal to RI bar minus RF bar divided by standard deviation I. And now Trainer versus Sharpe measures. Sharpe uses standard deviation of returns as the measures of risk. Trainer measure uses beta systematic risk. Sharpe therefore evaluates the portfolio manager on the basis of both rate of return performance and diversification. The methods agree on ranking of completely diversified portfolios, produce relative not absolute ranking of performance. Now, Jensen portfolio performance measure. Also, it is also based on the CAPM, that means capital assets pricing model. Expected return on any security or portfolios is given by ERJ equal to RFR plus beta J multiply ERM minus RFR. Also based on CAPM like ERJ equal to RFR plus beta J multiply ERM minus RFR, the expected return on any security or portfolio, where ERJ equal to the expected return on the security, RFR the one period risk free interest rate, beta I or beta J equal to the systematic risk for security or portfolio. ERM equal to the expected return on the market portfolio of risky assets. The information ratio performance measure. Appraisal ratio measures average return in excess of benchmark portfolio divided by the standard deviation of this excess return. That is determined by using formula IRJ equal to RJ bar minus RB divided by sigma ER, which is equal to ERJ bar upon sigma ER equal to alpha J upon alpha U. Application of portfolio performance measures. RIT equal to EPIT plus dividend of IT plus capital multiply DISTIT minus BPIT divided by BPIT. Potential bias of one parameter measures. Positive relationship between the composite performance measures and the risk involved. Alpha can be biased downward for those portfolios designed to limit downside risk. Component of investment performance. Pharma suggested overall performance, which is its return in excess of the risk-free rate. So portfolio risk plus selectivity. Further, if there is a difference between the risk level specified by the investor and the actual risk level adopted by the portfolio manager, this can be further refined. Investors, which is equal to calculated as investors risk plus manager's risk plus selectivity. And our component of investment performance. The selectivity measures is used to assess the manager's investment process. The relationship between expected return and risk for the portfolio is ER equal to RFR plus EMR minus RFR divided by sigma RM. Multiply covariance of RJ into RM divided by sigma RM. The market line then becomes a benchmark for the manager or manager's performance, which is calculated as Rx equal to RFR plus RM minus RFR divided by sigma RM multiply beta X. Selectivity equal to RA minus Rx into beta A. The selectivity component can be broken into two parts. Number one, gross selectivity is made up of net selectivity plus diversification. Selectivity, diversification. RA minus RX beta A equal to net selectivity plus RX multiply sigma multiply RA minus RX multiply beta A. Assuming the investors has a target level of risk for the portfolio equal to beta T, the portions of overall performance due to risk can be assessed as follows. Risk equal to manager's risk plus investor's risk. Therefore, Rx beta A minus RFR equal to Rx beta A minus Rx into beta T plus Rx into beta T minus RFR. Traders and Sharpe, relationship among performance measures. Trainers, Sharpe, Jensen, information ratio, pharma net selectivity measures, highly correlated but not perfectly so. So, performance attribution analysis like allocation effect, selection effect, which is equal to sigma I WAI minus WPI multiply RPI minus RP, which is equal to sigma WAI multiply RAI minus RPI. Measuring market timing skills, tactical assets allocation, arbitration Arbitration's analysis is inappropriate. Indexes make selection effect not relevant. Number two, multiple changes to assets class weightings during an investment period. Regression based measurement RPT equal to RFRT plus maximum of RST minus RFRT into RBT minus RFRT into 0. RPT minus RFR into T equal to sigma alpha plus beta B into RBT minus RFRT plus beta S RST minus RFR plus gamma maximum of RST minus RFRT into RBT minus RFR into 0 plus UT. Factors that affect use of performance measures. Market positions difficult to approximate. Benchmark error can affect slope of SML, can affect calculation of beta. Greater concern with global investing and problem is one of the measurement. Sharpe measures not as independent on market portfolio. And now benchmarking portfolios. Performance evaluation standard, usually passive index or portfolio, may need benchmark for entire portfolio and separate benchmarks for segment to evaluate individual managers. And now characteristics of benchmarks. Unambiguous. Number 2, investable. Number 3, measurable. Number 4, appropriate. Number 5, reflective of current investment options. Number next, specified in advance. And now building a benchmark. Number 1, specialize as appropriate. Number 2, provide value weightings. Number 3, provide constraint to portfolio manager. And now evaluation of bond portfolio performance. How did performance compare among portfolio managers relative to the overall bond market or specific benchmarks? What factors explain or contribute to superior or inferior bonds portfolio performance? And now a bond market line. It need a measure of risk such as beta coefficient for equities. Number 2, difficult to achieve due to bond maturity and coupon effect on volatility of prices. Composite risk measures is the bond's duration. Duration replaces beta as risk measures in a bond market line. Bond market line evaluation. Number 1, policy effect. Difference in expected return due to portfolio duration target. Number 2, interest rate anticipation effect. Differentiated returns from changing duration of the portfolio. Number 3, analysis effect. Acquiring temporarily mispriced bonds. Then trading effect, short run changes. Then decomposing portfolio returns into maturity, sectors, and quality effects. Total return during a period is the income effect and a price change effect. The yield to maturity or income effect is the return an investor would receive if nothing had happened to the yield curve during the period. Interest rate effect measures changes in the term structure of the interest rate during the period. And now, decomposing portfolio returns. The sectors or quality effect measures expected impact on returns because of changing yield spreads between bonds in different sectors and ratings. The residual effect is what is left after accounting for the first three factors. A large positive residual would indicate superior selection capabilities. Time series plot demonstrates strength and weaknesses of the portfolio manager. And now analyzing source of return. Total return are made up of effect of the interest rate environment I and the contribution of the management process C, where R equal to I plus C. I is the expected rate of return on a portfolio of default-free securities and the unexpected return U on the treasury index. So I equal to E plus U. Now analyzing sources of return. C is composed of M, return from maturity management, S, return from spread or quality management, B, return attributable to the selection of the specific securities, where R equal to I plus C, which is equal to E plus U plus M plus S plus B. Now consistency of performance. A study by Kirti Men revealed no relationship between performance in the two periods examined in the study. A future test also revealed no relationship between past and future performance even among the best and worst performance. Based on these results, Kretschmann concluded that it would be necessary to examine something besides past performance to determine superior bonds portfolio mechanism or managers. Computing portfolio returns. To evaluate portfolio performance, we have to measure it. From session number 1, we learned how to calculate a holding period yield which equal the change in the portfolio value plus income dividend by beginning portfolio value, where HPY equal to ending value divided by beginning value minus 1. Computing portfolio returns. Dollar weighted rate of return, DWRR, internal rate of return on the portfolio's cash flow used in capital budgeting techniques. Time weighted rate of return, government or geometric average return TWRR is better, considers actual period by period portfolio returns, no size bias, inflows and outflows could affect results. AMIRR RPS have the following goals. Number 1, achieve greater opportunity and comparability among performance presentation. Improve the service offered to investment management clients. Number 3, enhance the professionalism of the industry. Number 4, bolster the notion of the self-regulation. Performance presentation standard. Total return must be used. Time-weighted rates of the return must be used. Portfolio valued, quarterly and periodic returns geometrically linked. Composite return performance, if presented, must contain in all actual fee paying accounts. Performance calculated after trading expenses, taxes must be recognized and when incurred. Annual return for all years must be presented and disclosure requirements. And now do it yourself. What is bond market line? How it is evaluated? And question number 2, what is consistency of performance? And that's it from session number 11. Thank you.